Okay, so the latest silver futures warehouse report came out, and it shows about 100 million ounces of deliverable silver sitting there on Friday. The official word is basically chill, everything's cool. I wasn't even planning to make this video. Right now I'm literally cleaning my kitchen. I'm standing there staring at a mug I should have washed yesterday, and I'm like, wait, are we seriously about to see this happen again in the silver market? Because this isn't the big headline you'll see if you just scroll through the usual stuff. I think you deserve to hear the whole thing. So here we go. It's Sunday, February 8th, New York time. Drop a comment with what day and date you're watching this on. Quick heads up before we jump in. I'm trying to get rid of all the fake copycat channels. If you like this kind of real talk breakdown, hit subscribe and comment our John AG so the platform knows who you're supporting. Now if you own silver, trade silver, or hold anything connected to silver, like coins, bars, mining stocks, funds, futures, whatever, then the next few weeks could turn exciting in a way most people won't expect. And it's not because silver has weird feelings or anything. It's because the behind-the-scenes stuff under the price is starting to get squeezed. No, I'm not saying the world is ending. I'm not calling the exchange bad. I'm not even saying something has to break. I'm just saying the situation is strange, and the dates on the calendar aren't helping. Here's what I'm going to lay out for you, and I'll keep it short because I don't want this to drag like a long bedtime story. 3 main things. First, what those deliverable numbers really mean and what they don't mean. Second, why one specific date, February 27th, matters way more than all the crazy hot takes. And third, the realistic ways this could play out. The boring way, the wild way, and the one almost nobody mentions. And yeah, I'm double checking, we're recording. Yep, good. Let's roll. Okay, let's start with the thing everyone fights about online all day. Inventory. You'll hear people say, there's tons of silver just sitting in warehouses. And in a simple way that might be true, but it can also mean nothing important, because the silver futures system has different categories. If you don't get the categories, it's like reading a restaurant menu and thinking the food is already sitting in front of you. In the exchange's words, metal is either eligible or registered. Eligible means it meets all the rules. It's in an approved storage place. It's real metal with real bars, real weight, real serial numbers, but it's not automatically up for grabs. It's more like it's locked in a safe storage unit. You can see the unit is there, but you don't have the key. Registered is different. Registered is eligible metal that now has an official warehouse warrant against it. That's like the title paper that makes it ready to deliver through the futures system. That's the stuff you can actually pull when someone asks for delivery. So when someone flashes a huge total inventory number at you, ask one simple thing. How much of that is actually registered? How much is really ready to go through delivery without having to ask the owner nicely? From the latest warehouse updates, the registered amount is sitting roughly a bit over 100 million ounces. That's not some prediction, that's just the picture right now. It could change tomorrow, but that's the picture we have today. Now here's where tons of people lose it right away. They look at open interest. That's how many contracts are still open. And they do big scary math, like every contract means someone showing up with a truck to haul metal away. That's not how futures usually go. Most futures get closed out or rolled over. A huge part is hedging. A huge part is spread trades. A huge part is people just betting which way the price goes without ever wanting actual metal. So let me be the grown-up here for a second. Open interest is not the same as delivery demand. If you mix those up, you'll freak yourself out and make bad choices. But, and this is a big but, delivery demand doesn't need everyone to join in to make a difference. It just needs enough people at the wrong time, when inventories are already low and borrowing costs are already going up. And that brings us to the calendar. February 27th is first notice day for the March silver contract. First notice day is the point where things switch from just trading paper bets to, okay, if you're still holding the buy side, you can now get told to take delivery. It's when delivery stops being just an idea and becomes real. That doesn't mean every single person takes delivery. It means the system has to be ready for whoever does want it. Think of it like a hotel. Most of the year. Nice lobby, cool website, tons of bookings. But on first notice day, the actual people who walk up to check in matter way more than all the bookings that get cancelled. And March isn't some random month. March is one of the big months for delivery in this market. That's why this date is blinking red on my radar. From the latest numbers out there, the March positions are big enough that if even a small part of them ask for real metal, it could take a serious bite out of registered inventory. Not wipe it out completely, not right away, but enough to start some panic. And panic messes up prices bad. So the real question isn't will the exchange run dry tomorrow? The question is, what happens if we head into that delivery time, with registered inventory dropping, while more people want actual physical silver? And yeah, I said dropping because another strange thing is the flow. Lately, the vault reports show metal steadily leaving. Not every single day the same, but the overall direction is clear. Withdrawals are really happening. At the recent speed, it's like around 750,000 ounces leaving per day on average, more or less. I know what you're thinking, John. That sounds massive. It is massive. But here's the pushback side. Because I'm not trying to trick you. Warehouses aren't like a tub with just one plug draining. They're more like an airport. Planes arrive, planes leave. You can have a week with lots of departures and few arrivals, and it looks like everything's emptying out. Then a week with tons of arrivals, and the whole story flips. So outflows matter, but the big question is, what brings metal back in? That usually depends on rewards, price differences, extra fees, interest rates, and trust, which takes us to the borrowing market. One quiet sign of tightness isn't the main price at all. It's how much it costs to borrow physical metal for a little while. If you need to deliver metal you don't have yet, or want things to go smooth, you borrow it. The rate you pay is like a stress gauge. Lately, reports show lease rates shooting up into high single digits levels that make people sit up and notice. In normal calm times, those rates are super quiet. They don't yell, they whisper. When they jump, it's not the end of the world. It just means people are fighting over the same limited pool of easy-to-get metal. And to be straight, lease rates can jump for reasons that have nothing to do with actually running out. They can come from financing costs, from how people are positioned, or from a short scramble at settlement time. So again, grown-up talk. One sign by itself doesn't decide everything. But when you put together calendar pressure, low registered inventory, steady withdrawals, and higher borrow costs, you get a picture. And that picture isn't relaxed. Now let's pull back, because I promised some bigger picture, not just warehouse drama. Silver isn't only a pretty thing people buy to keep. Silver is a useful metal. It's in electronics, electrical parts, industrial machines, and yeah, in solar panels. And solar isn't some tiny side thing anymore. Recent US industry reports say the country added double-digit gigawatts of new solar in just one quarter late last year. And there's still a big lineup coming. A National Labs recent industry slide deck said US solar installs last year hit around 50 gigawatts direct current. That's not a mistake. That's a whole new level of need for parts, wires, and everything connected to the power grid. Around the world, it's even crazier. One global solar tracking group estimates the world added something in the high 500 gigawatts of solar in a single year. That's tons of panels, tons of connections, tons of metal going from underground to on top of roofs. Now, does every panel use exactly the same amount of silver? No. The industry keeps trying to use less per panel. But the simple point is this. Even if they use a little less per unit, total demand can still shoot up because so many more panels are being made. And that's not even counting all the electric stuff. Electric cars, charging stations, grid improvements, data centers, all needing good conductors. Silver isn't the only one, but it's one of the best at carrying electricity. If you want a plain official breakdown of silver uses, US Minerals reports lay it out. A big part goes to investment coins and bars. A big part goes to electronics, and a solid chunk goes straight into solar panels. That mix is important, because silver lives in two places at once, the money and feelings world and the real factory use world. That's why it can stay quiet for months, then go completely crazy in a week. Now let's talk supply. Because this is when the just dig more people jump in. A lot of silver isn't mined because people wanted silver. It's mined because people wanted other metals, and silver tags along. US Minerals data explains it clear. Silver mostly comes as a side product from lead, zinc, copper, and gold mines. Those multi-metal deposits make up a big share of what's out there. Simple translation, if silver prices jump high, it doesn't mean mines can suddenly pump out way more silver overnight. You can't just yell at a copper mine and turn it into a silver mine. Mines move on their own slow schedules and their own money rules. So when demand goes up fast and supply can't catch up quick, something else has to give. Usually, price. Sometimes people switch to other materials. Sometimes old stockpiles get used. Sometimes the paper market does tricks to hold things steady. until real metal arrives. And that's why we come back to the futures exchange, and why February 27th isn't just some random date. The futures market is supposed to help connect producers, users, and traders. But it also depends on trust. Trust that if someone wants real delivery, the system can do it. Trust that the price you see matches real ability to get metal. When that trust shakes, the market can go two opposite ways. It can shoot up because everyone rushes to grab metal, or it can drop hard because the exchange changes rules, raises margins, and kicks out big speculators. And before anyone freaks, yes, exchanges change margins all the time. They just had public updates about margin rules and silver margin levels going up, meaning more cash needed to hold positions. That's not evil, that's them managing risk. But managing risk has consequences, and those consequences usually hit the most borrowed up people first. So here are the 3 ways this could go. Listen close, because what you do depends on which one you think is coming and how much stress you can take. Path 1, the boring one. We hit first notice day. Delivery requests stay normal. The system finds what it needs. Eligible metal quietly turns registered. The whole thing is no big deal. Silver price bounces around. Online people say they were right. Everyone moves on to the next argument. Path 2, the chaotic one. Delivery requests come in higher than normal. Not everyone, but higher. Registered inventory looks low. Lease rates stay high. Price gaps widen. The market feels the stress. And then wild swings feed more wild swings. In that case, paper prices can bounce everywhere, while physical extra fees in some spots stay strong. You don't need the whole world to run out for that. You just need jams in refining, shipping, storage, timing. Path 3, the one people whisper about, a credibility event. That's when the market starts seeing paper silver and real right now silver as close relatives. Not the same thing. The futures price turns into more of a guide number, and what you actually pay depends on your location, how quick you need it, and who you're buying from. We see little signs of this in other metals sometimes, and we've seen it in gold before, where some delivery spots trade different from others. It's not made up. It's what happens when place and timing beat the spreadsheet price. And that's where location messes up everyone's neat chart, because silver isn't in one spot. It's in vaults, refineries, trucks, customs forms, shipping plans, someone's will ship next quarter message. So even if the world price is one number, your real cost can be that number plus extra hassle. Lately, that hassle shows up in ways you can spot. There have been times Asian prices stay strong compared to Western futures, then snap back, then gap again. Like the market can't decide if it's tight or just jumpy. Some talk even points out times when the extra fee looked really big and didn't close fast, because moving metal across countries isn't like shifting stocks between accounts. You've got different bar types, approvals, money costs, time, and sometimes rules that make quick fixes harder in real life. And this matters because futures markets are built for people who almost never want delivery. That's not just my view. That's how they normally work. Most futures get closed or rolled instead of turning into real metal swaps. That's why first notice day usually goes smooth. So if suddenly more people than expected demand real warrants in a tight window, it puts pressure on the system, even if the system is basically okay. And here's the surprise factor. What if the extra buyer isn't just a gambler this time? What if it's a factory that just wants to know they'll get metal when they need it? If you're making electric stuff on a big scale, not knowing is deadly. You can hedge price with paper bets. You can't hedge we can't get metal on time with a chart. That's why I keep asking, is this just a trading thing that flares up and dies, or a trust thing that changes behavior for years? You don't spot the trust thing from the main price. You spot it from the behind-the-scenes pipes. Now I'm going to push back on one idea floating in a lot of silver talk right now. The idea that if open interest is huge and registered inventory is smaller, the exchange has to fail. That's a catchy story. It's also too easy because the system has safety cushions. Eligible inventory is there. Metal can move when the rewards get better. Quick buy, low sell, high fixes happen. And most important, most futures people don't want delivery. So a paper mismatch doesn't always turn into a real failure. But here's why I'm still watching. The things that make a trust problem more likely aren't one simple number. They're actions. Steady withdrawals, high borrow costs, repeated delivery pushes, and growing doubt. And there are signs of exactly those actions. For example, recent market reports show the whole precious metals area in crazy volatility and big speculator interest, with silver swinging hard and getting tons of attention from regular folks and borrowed traders. That matters, because crowded markets turn small bumps into huge swings. On the real metal side, there are reports of tightness in big trading cities, with borrow costs jumping and spot prices moving different from futures at times. Again, not the end, but proof. This isn't a quiet, sleepy market. So what do you do with all this? First, don't turn into a conspiracy nut. Second, don't turn into a borrow too much nut. Those are the quickest ways to lose big. Let's talk borrow for a sec, because that's where people get wrecked. Silver isn't gentle. It can move like a crazy tech stock, and if you're too borrowed, you don't get to hang on. You get forced out, then you watch the market do what you thought while you're sitting on the sidelines. So the best question isn't where silver is headed. The best question is how much of my money is at risk if silver goes nuts in the next couple weeks. Here's an easy way to think without getting complicated. If silver is just a tiny piece of your money, like low single digits %, even a big wild move is annoying, but you survive. If it's a giant piece, a wild move isn't annoying. It's life-changing bad. And silver has a history of big violent moves when the market setup gets stressed. Sometimes up squeeze, sometimes down flush, sometimes rule change, sometimes pure panic. We've seen times in past years where exchanges tighten things during big spec runs and price drops hard. The lesson isn't to memorize history, it's to respect how the system works. When borrowed money piles up, rule changes and margin hikes can chain react. So question for you, is your silver bet something that relies on someone else's word, or something you hold yourself? I'm not saying one is bad. I'm asking because the risks are different. Paper stuff like funds, futures, unallocated accounts is easy and quick to trade. No storage worry. But in extreme times, it can have trust and settlement risks. Even if it all works, paper can follow price while real buying fees act different. Physical coins, bars, stored allocated stuff, cuts some trust issues but adds real hassles. Storage, insurance, selling ease, price gaps. You give up easy for control. And if you're asking, okay John, which is better? Wrong question. Better question is, what am I actually trying to do? Protect against inflation worry. Bet on price jump. Spread away from stocks. Lock in factory supply. Those are different goals. Now another question. Do you think February 27th goes quiet? Or do you think we get a big news moment? Tell me in comments, because I'm really curious what you're seeing. And while we're on comments, here's something bigger than people think. If you've had wins, share your story in comments to keep others going. Now let's think what could really happen around that date. In real life, futures delivery has steps and papers. You don't just yell, I want silver and get a bar. There are notices, assignments, warehouse papers, warrants, moving accounts. That's why registered matters. That's why warrants matter. And why behavior changes show in data before news. If delivery demand surprises higher, the system has tools. It can make delivery cost more with higher margins. It can limit positions. It can tweak rules on who holds what. All that can calm things. But it can also shake out shaky players hard. And here's a small, fresh detail many missed. The exchange has been changing contract types, like adding a smaller silver futures option, which changes who can play and how. Smaller ones can bring more people in. They can also bring more gambling. So setup matters. Now you might wonder, is this good for price up or down? Honest answer, it depends which path. The chaotic path can push physical prices up while paper goes wild. If exchange hikes margins, paper can fall even if physical fees stay high. That's not weird. It's different events. Boring path is nothing. Credibility path can change things big, but not like movie collapse. It can mean bigger gaps, wider spreads, higher money costs, local fees, slow change in how people see the main price. Now one more fresh layer, because it explains why stress exists. We're in times where governments and factories care more about key materials, supply lines break easy, refining isn't unlimited, industrial need isn't optional anymore. It's linked to electric goals, strong grids, making stuff rules. Mix that with most silver being side product, and you get a market that stays tight long times. Even US mineral reports say world use beats supply, and that's listed as why prices rose. That's not some video guy, that's dry official talk. So what to watch from now till first notice day? 1. Watch registered number trend. Not one day, the direction. 2. Watch if withdrawals speed up or slow. Trend again. 3. Watch borrow costs and spot versus futures in big places. If spot stays strong versus futures and borrow high, market says real metal is worth extra. 4. Watch exchange risk updates. Margin changes flip short-term player moves. 5. Watch the talk. When talk goes from nothing weird to this is normal, it can mean hidden fixes are happening. Now the boring opposite story nobody likes, because it's not exciting. Maybe inventory worry is overblown. Maybe eligible turns registered easy. Maybe outflows were just moving stuff around, not shortage. Maybe lease jump was short money glitch, not big lack. Maybe lots of March bets roll over before delivery. All possible. So if your whole plan is exchange must break, that's not a plan. That's hoping. Hopes aren't risk control. But if your plan is know the weak spots, skip borrow traps, keep your size small enough for wild swings, you don't need to guess collapse. Just respect the setup. And honestly, the setup is worth noticing. First notice day is close. Registered isn't huge. Factory demand is real. Market setup is touchy now. So here's my simple plan. Step 1. Know your goal. Trading short? Investing long? Hedging something? Write it, or market writes it for you. Step 2. Know your risk. Pick size you can sleep with. If you're up at 3 a.m. checking prices, too big? Step 3. Know your tool. Can't handle trust risk? Don't fake it. Can't handle storage hassle? Don't fake it. Choose trade-off you live with. Step 4. Know your change point. What flips your view? Margin jump, delivery spike, warehouse turn. If nothing changes your mind, that's not strong belief. That's being stubborn. Now one last big zoom out, because this is bigger than silver geek stuff. This is about trusting price signals. In healthy setup, paper price and real stuff stay linked. They drift short, then snap back because quick fixes work and market balances. In stressed setup, link breaks not on purpose but from limits, money, shipping, rules, jams. When link breaks, people pay for sure things, pay for now delivery, pay for right spot metal, pay for trusted sellers. So if you're thinking why care if I'm stocks only, metals feed factories. Energy switch needs tons of materials. Same supply problems hitting one metal can spread. Markets show stress in corners before big indexes. Now the one thing not to do? Don't think you can beat a wild swing with a stop order and hope. In fast markets, stops turn into fuel. They don't save you, they fire you out. And don't think exchange has one tool. If stress climbs, they can hike margins, tighten limits, nudge settlements to make trades less fun quick. None changes panel building or circuit making, just who holds risk and how long. That's why I'm tracking not just price but rules, flows, tone, official notes, every day till this passes. Okay, wrapping up. February 27th is real on calendar. March delivery is real process with real steps. Registered is real category with real point. Industrial demand isn't joke, it's trackable. But none promises big boom. Just higher chance of wild moves. And wild moves punish unprepared. So my ask, if you don't want copycats taking over, subscribe, comment our John AG, and share with one person who thinks inventory is one number. And tell me if market goes nuts into first notice day, you think bigger move is squeeze up or forced flush down. I want your thoughts, because good points both ways. Alright, I'm off to wash that mug, and if warehouse numbers go crazy, I'll jump back on. One last thing I gotta say. This is learning stuff from public market info and general industry stuff, not personal money advice. I don't know your life, risk level, or goals. Do your homework. Talk to pro if you need. Never risk money you can't lose.